So with March year ends coming up, what that means is you should know where your profits are going to be at this point in time. And if not, you should, because certain things in terms of tax saving opportunities can't be done retrospectively. Some can, but the key is making sure that you have already thought about them when you're having conversations with your financial advisors, your accountants, to make sure you're ready. So the purpose of this is to kind of go through a few things that business owners who have got a March year end for their limited company are considering. Yeah, so a big one that can be a massive tax saver for limited companies is directors' pension contributions, lump sums done at the end of the year. The key to it though is where there can be a bit of a difficulty knowing what pension contribution to make is if you don't know where your profits are. If a limited company earns profits between 50k and 250k, they fall into the marginal rate, which essentially becomes like a 26.5% tax bracket. If you don't know where you're at, you don't know if the pension contributions are going to be saving you 25%, 26.5% or 19%. So the key is doing that. But what business owners can do with the pension contributions is, if they haven't used up the pension allowances in previous years, they can do a lump sum to catch up. So prior to this year, it was 40k pension allowance contribution everyone was allowed to do. If you made no pension contributions in those previous 3 years, you could use up all of those allowances in this current accounting period, plus then the 60k you've got for the tax year ending 5th of April 2025. So if a business has the cash, there's a big opportunity to move their bracket of where their corporation tax will fall. The key to being able to make this is having your accounts up to date. You know, you can't do this 3 months after the year end, because pension contributions, the tax relief is on a paid basis, you can't accrue for it. If you do accrue for it, it's just added back on the tax computation. So you've got to kind of know where you're at before the year end. And typically, if you haven't already got a pension scheme set up, you need to be speaking with your financial advisor a month, 2 months in advance to make sure that's ready. So then you can drop the funds in when you can. Yeah, so gift cards are a really easy win for directors and also their staff. Directors each year should at least use their 6 times £50 gift card allowance. If you were to do it in one £300, that isn't tax deductible, it's treated as a benefit in kind, but 6 £50 gift cards, say for Amazon, they can be tax deductible. So each director should be at least doing that for themselves, you know, either before Christmas or they should be doing it just before the year end, just making sure they use that allowance. But the beauty of it as well is there's no limit on how much you can do for your employees. So you could do up to 500 in £50 instalments for your staff. Obviously, it's kind of one of those things where you don't want to kind of go to the nth degree and it's in lieu of them actually getting a salary, but as long as you are, you know, it's something to consider. For a limited company, you'll have new hires, you'll have new equipment that you'll need, new computers or whatever. If you are coming up towards the year end and you're having these considerations of, oh, we've got a new employee starting next month, may as well get the equipment before your year end, because then you're going to kind of subsidise the cost of that equipment through tax savings. And if you buy it kind of on the 1st of April, you're not going to kind of get that reduction benefit until, 12 months after? Well, and then 9 months after that for when the tax actually falls due. If it's a big asset that a funder will be happy to kind of take security on, you can finance that asset and then pay it over a period of time. But because how you get tax relief on assets is done on the tax computation, it's treated as an asset and you claim annual investment allowance or potentially first year allowances. So it's on the value which goes on your tax comp. So you might not have had to have paid it off, but if the asset is in your accounts and you've kind of, the agreements are dated before the year end, then you can have the full tax relief. For a lot of business owners, they need to kind of consider how they claim the mileage. If they're using an appropriate accounting software, there should be some functionality on there to put that in as you're going along, but it may also be a case of doing it as a lump sum at the end. The idea is you do it as you go along, but for electric, so especially for directors who've already invested in electric cars and kind of got the first year allowances on those, they will be able to claim back the kilowatt hours they have charged for their electric vehicle back against the business. I believe the rate is around 6-7p per kilowatt hour that you can claim back, and that's on all of the kilowatt hours used. You don't have to do any sort of proportion of business versus personal element as it currently stands, but that could be subject to change as kind of the green incentives that the government are looking for may vary. But yeah, it's something that you've got to consider, and especially for those who've already got electric cars, it's an absolute no-brainer. Yeah, so typically, especially with COVID, the £312 being £6 per week was used quite extensively, but for a lot of business owners, they work from home, so there's a consideration of being that do we need to factor in other costs such as light and heat. You know, as long as we can put an argument together and we can justify this individual works from home and 1 out of 6 homes in their residence is dedicated purely to kind of working, is a kind of a home office, then we can then bring in 1/6 of those costs. And we just have to make sure that if we are doing something like that, it's done on a reasonable basis and you're not taking the mickey, but we just need to be able to kind of justify it if HMRC ever were to come knocking. Thank you very much for watching. If anything in here is interesting, your year end's coming up, might not be March, might be in the next couple of months, do let us know, because it's opportunities that are missed. So just make sure that you are proactively considering what your profits are before your year end and how you might be able to mitigate some of that, especially if you are in that marginal rate of tax that can be quite vicious for business owners and limited companies.